afternoon, and thank you for joining us for Surge Energy's Q1 webinar. Surge trades under the ticker symbol SGY on the TSX and ZTPAF on the OTC. With us today from the company are CEO Paul Colborne and CFO Jared Ducs. The company had a nice production beat of 22% year over year in the quarter at 21,138 BOEs, which is above your forecasted exit, but I'm assuming that some flush in there. But you can speak to that. I will turn it over to Jared and Paul to run through some of the highlights on the quarter, and then we'll do a Q&A. Please enter your questions in the Q&A box or email me at jessica@adcap.ca. And as always, the presentation may contain some forward-looking statements. Welcome, guys.
Thanks for having us. I'm Paul, this is Jared, and we're going to do this a little differently. As Jess said today, we're just going to hit the highlights. Surge just put out a record quarter this morning and have had great recognition in the market from all our analysts. I think we're covered by 11 or 12 firms. We've had some targets even go up. I think Peters & Co. and a few others have made us one of their top picks in Canada for oil. So we're kind of thrilled about the quarter. It's a record quarter, so we're going to kind of go through that. Jess has got a few questions as well, and then we'll flip it over to the audience for any questions from the audience. So if that works, we'll get going. The quarter was record production for us, over 25,000 barrels a day average for the quarter. So I think any business where you'd say you averaged in the first quarter higher than your projected exit the year production exit rate, you'd go, wow, that company is right on track or going to exceed guidance. That's what we just did. So it's up about 22% over last year, Q1, and it incorporates our first quarter of the first year of the amazing Enerplus acquisition that we closed on December 19 last year. So that was a $245 million acquisition that has just turned out to be a wildly accretive, very well accepted, kind of almost changing type, transformational type acquisition for us. It's two core area chunks of production, 2,000 barrels each in our Sparky and Southeast Saskatchewan core areas. One thing we'll touch on in a bit, I'm going to flip it over to Jared in a second here to talk about the financials on the quarter. We've already started drilling the Enerplus assets in the Sparky core area. We saw somewhere around 35 drilling locations on the Cadogan property. We've already drilled the first two. They're already outperforming type curve expectations in the Sparky. So we see the first two wells drilled doing very well, and 32 more locations there just on that one property alone. Those were completely unbooked in the engineering report when we bought the Enerplus acquisition. So we're quite excited about that upside. Jared's going to talk about the financial highlights of the quarter. Jared?
Thanks, Paul. Yeah, as Paul mentioned, we're really excited about getting our first quarter out with Enerplus, generating that record production, and to do that in the face of a couple headwinds for sure. WTI, of course, was down by about almost 20%, nearly $18 US a barrel. Canadian WCS differentials were a little wide in the quarter, but still in the face of that, because of the asset base we built here at Surge. We generated a 4% increase in our cash flow from operating activities. So we took that up to $54.5 million from $52 million in Q1 of last year. So doing that even while oil prices were challenged on a comparative basis, we think speaks to the strength of the assets that we have here at Surge. Generated significant cash flow, reduced net debt by about $20 million in the quarter, and paid out $12 million of dividends to our shareholders. So great, successful quarter here, and really is highlighted, as Paul will speak about here in a moment, by our operational success as we drilled those 18 gross, 17.9 net wells in our two core areas, which are two of the top plays in Canada.
So I'm just putting out a little research paper, and showing how well it fits Surge's model, but pop quiz for everybody listening. What's the number one performing best investing model of all time? There's a Wall Street Journal paper that just sent me this morning, research piece, an article on Warren Buffett that verifies it, but also the Ned Davis research that almost everybody cites over the last 60, 70 years. Well, it's the increasing compounding dividend model is wildly the #1 performing investment model of all time. Well, that fits Surge to a T. We have 3 billion barrels of net oil in place. We've only cummed 7.7% recovery factor from those pools today. To date, we have over 1,000 drilling locations. We're only drilling 70 this year. We have one of the lowest corporate declines, 23%. Beautiful water floods backing that. And 2 of the top plays in North America for oil, our Sparky play and our Southeast Saskatchewan shallow conventional plays. Our plays work at $40, $45, $50 oil. Imagine how good they are at $68 to $70 oil or even higher this year, which we all think crude's going to do. But our plays work dramatically great at these price levels that crude's at today, even after the precipitous drop in the last 2 weeks. So we're thrilled about it. You got a base dividend of almost 6% today while you wait for the market to turn here. And we had a really low payout ratio. Our dividend was only 18.75% of our cash flow on the quarter. So a really low payout ratio with Surge. Later in the year, maybe give 2 seconds a bit on what to look forward to. If crude rallies here back to that $80, $85, $90 level, we've got some pretty aggressive plans, not just in bumping the dividend, but some of the other things we're looking at, like share buybacks.
Yeah, well, exactly. As we look at a rebound in crude here to the levels Paul just described, Surge is well positioned to look at increases in the base dividend at those price levels. Starting an issuer bid that's available at times like these when you have these dislocations in the market where bank failures are driving oil prices down. Take advantage of that with the PDP NAV Paul spoke of. You can be buying your own stock at around proved developed producing. Those are really attractive levels. So an ability to do that once we reach that phase 2 target we've talked about in the past. And then there's, of course, in commodity spike, times of commodity price spikes, variable or special dividends as well. Look for us to continue to pay down the debt in the near term, add to our shareholder value that way by adding to the net asset value or NAV, paying down debt, accrues to the shareholder in that fashion. So a lot of ways for us to hand that free cash flow at those price levels Paul referenced out to our shareholders here in the coming quarters.
So that's our synopsis on the quarter. Just got some questions, but I do believe from what I can tell, we've got probably 7 or 8 of our 11 analysts have reported. We're waiting for the last few, but almost everybody is, in fact, every single one has said it's a great quarter. We agree, record production. So we're kind of thrilled about it. And I think the reception's been good. It is a lousy day to put out your quarter, given the, as Jared called, market dislocation, but that'll heal quickly. And our dividend, we're only a few days away from our next monthly cash dividend while we wait. So that's our story on the quarter. Jess, why don't you take over now for any questions you would have for Jared or myself?
Okay, a few of them he answered, of course. But anyway, we'll dig in a little deeper. So let's start with the macro. Obviously, it's very topical right now, given what's happening with the banking crisis. China PMI numbers being slightly below anticipated. We've seen some demand erosion in diesel, but nothing major in the U.S. But still, it's been there, and of course, the debt ceiling in the U.S. So, you know, I think there's been a lot of paper trading on oil, which is not necessarily representative of what's happening in the physical market. But technically oil has broken down. So I think people are trading a range. If you do see it come down to the $65 mark, would you cut your capex at all? Most of your plays are all very economic, as we know. But would you reallocate some capital, like we talked, like you mentioned, to an NCIB if you would go below your PDP, something like that?
Yeah, good question. We always are looking at that. We just had our weekly management meeting and discussing that topic. We just saw oil about 2 months ago go from over 80 down to 62 or 3 on the Silicon Valley Bank going under. Oil just seems to be the whipping boy for any bad news, economic news in the world. We didn't consider cutting our capital at that time. Now, are we high grading our capital? We have a lot of in our budget. I wouldn't call it padding, but we have some discretionary land, seismic, waterflood capital, infrastructure capital, things that we, and certain wells that are more exploratory. So we're already scrubbing that. And again, the good part for us right now, we're just sitting here paying debt down during breakup. Breakup's about as those listening, is about a 2-month sojourn during the middle of spring, where road bans come on and we can't move our rigs in and out of our leases to drill wells. So all we do is sit here, pay our dividend, enjoy the great quarter we just put out, record production and cash flows, enjoy those, and then gear up for the second half. So during that period, this period right now, we're already scrubbing for all the discretionary items that we can take out. And I don't even mean take out, Jess, it's a good question when you say cut the capital. We're going to spend, if we kept our budget, 85 million in the next 4 months, from June 1 to the end of Q2 or Q3. So now we're saying, given what crude's done, our plays are so economic that our wells work at 40, 45, $50 oil. Let's go ahead and drill the base program and cut out discretionary expenditures. An example would be the big discovery we had in Q4. We drilled an exciting well late Q4, early Q1 at Hope Valley. It's an exciting 7-leg open hole well. Multi-sections we've assembled on it. The well looks good. We want to drill an offset to that in Q3. We were going to drill 2 there and maybe 1 more to the north on the Interplus lands that look like they're part of the same huge pool. So we might drill just 1 well there instead of 3 additional wells by year end, because we want to keep progressing that play. So there's an example of some discretionary cash or capital that we can cut out of Q3. Now, if crude rallies back like we think it's going to over the next 3-4 months, we'll keep that program and add those 2 wells into the fourth quarter. Right now, we're just already looking at what we can cut out of the 85 million we're going to spend. Our most aggressive spending period is from June 1 till the end of Q3. So we're already looking at all that, but cutting capital yet to drill wells, no. Discretionary capital, yes, we're looking at that closely. Is that fair?
I think it's perfect. Great synopsis. Yep.
And you're in a perfect position because like none of those wells that you mentioned that are discretionary are in your budget. So you can still more than make your numbers with a base budget if you did need to pull back a little bit on some of the other capex you just mentioned. So
Yeah.
Being where you are. Now, Cadogan. Let's talk about those wells because those were pretty exciting and they're still cleaning up. So we could see better than they're doing 300 BOEs a day out of 2, and like you said, still cleaning up. And with the 35 locations there, do you see maybe some reallocation of capital to that area?
Yeah, for sure. As part of the high grading that Paul just described, very encouraged by the initial rates there. Our typical type curves have those wells coming on at about 125 barrels a day in Sparky. So obviously you can see with the math there that these are encouragingly above that and still cleaning up. So for sure, you're going to see us pivot some more capital into this area. Again, not additive wells, but it's part of that high grading that Paul spoke of, where we can go in and get more production for the same money or get the same production for less money, however you want to think about it. So that's definitely an area where you can see us drilling 6 to 8 follow-up wells this year. Fabulous asset for us. We see 32 remaining follow-ups down there. As you well know, we acquired that through Interplus. The moment we got that in our hands, started surveying and planning to drill there. We've coveted this area for going on nearly a decade, trying to get access to it. We've tried several times with Paul's leadership to try and acquire these assets and just thrilled to have got them and have these initial results to show the market.
So think of this, Jess. We bought about 495 barrels a day at Cadogan in the Interplus acquisition. With the 35 locations we have to drill, the first 2 are doing 300 barrels combined. So we usually use around 80 barrels for every well, first year average. So you're probably looking at taking 495 barrels, 500 barrels, and I think we can peak this out over 2,000 barrels a day, this pool. Now it's in a greater huge discovery. It's just 2.5 sections in the middle of the huge discovery we've had under the town of Provost, to the west, to the north, to the south. We're now thinking that Provost could end up being a 4,500, 5,000 barrel hub in the Sparky for surge. And this is literally the hole in our donut, as Jared said, that we've coveted for 7 years. And to buy it with an engineering report where none of the 35 locations were booked. And now we've already drilled the first 2, and our type curve is 125 barrels a day. And the first 2 wells are already over 300 barrels of oil a day and still cleaning up. And when we say cleaning up, that means they're not pumped off and there's lots of fluid in the well bore. So that means we think we can get more out of the wells. So already they're nicely over our type curve, but we're quite excited because we've already got the batteries there, the gas plant there to take any takeaway on gas. The numbers we gave you are just the oil, over 300 barrels of oil so far, not cleaned up yet.
So if this, do you have to buy any more land in the area, or do you own it all?
We own it all, dominate it all, and that's why I'm glad you sent me that email last night saying, hey, can I talk about Cadogan? There's no more land to be had, and we're worried, to Jess's very good point, just as we're finalizing the deal with Enerplus in the fall, we drilled 4 of the best ever Sparky. We've drilled 240 of them now. So we drilled the best 4 locations we've ever drilled in the Sparky, 100 meters from the Enerplus lands. And I was like, don't tell anyone about this. And then they came off confidentiality. There's a 30-day confidentiality period. So we're scared they were going to see these wells. At one point, the pad was doing over 800 BOE from our 4 wells. So the exciting thing is that gave us more and more confidence on the Enerplus deal. It is nice to have the first 2 wells into the pool already exceeding type curve, but we dominate and own all the land on the play now.
Well, that's awesome. That's awesome because it gives us, I mean, the Sparky's been phenomenal. It's not over 9,000 BOEs a day now. And I mean, you've grown it organically, which I don't think a lot of people understand. And there's still so much more running room on this play. And then you have the water floods on top of that. So that's congratulations on that. And do you foresee, like, you've been drilling, the type curves continue to get better on the Sparky. Do you see there's potential for the engineering type curve to come up from Sproul?
It's been it's already ranked the 4th best play in North America on primary. What that means is just drilling, pay out of the well, and not counting water flood. And on that, there's a slide we have in our corporate presentation that talks about it, but it's the 4th best play in Canada, the Clearwater, our Southeast Saskatchewan, Frobisher, and Midale locations, the Charlie Lake, and then our Sparky. But if you add water flood in there, we book 125,000 barrels on for a conventional Sparky well with Sproul. When we put the water to it and water flood it, we're now booking over 400,000 barrels per Sparky water flooded well with Sproul. So if you add water flood, we think it's the best play probably in North America, and almost no risk. It's a beautiful sandstone at just 700 meters depth. The wells only cost $1.5 million, $1.6 million to drill. So yeah, we're kind of thrilled about it. The type curves I don't think are massively going to change. Although I say that when you get a pool like a Cadogan, it can change the corporate type curve a little bit. But we've got it down to a science after 240 locations, successful wells in a row. Basically, the P10 is the P90. That means the probability is almost of getting a good well is almost certain. So the good wells are the bad wells. Basically, they're all good, and that's really exciting. So there's almost no risk on our Sparky program, and we now have over 480 locations and we're only drilling about 37 Sparky wells this year. So it's quite thrilling to have that deep of an inventory, and then, as just said, the water flood on top of it.
Yeah, it's almost become more like a resource play than
It truly has. Yeah, exactly.
Yeah, the benefits of a conventional asset with the scale of almost a resource play. So really, it's really starting to feel like the best of both worlds.
Yeah, no, it's been a phenomenal play for you guys. And the lucky thing is that you were there early and picked up all the land and no one else was, paying attention. So that's okay. So on to let's talk a little bit about the Frobisher again. You're drilling great wells there. Are you trying some new completion techniques as well there? Or are you doing anything different?
So the great thing about Southeast Saskatchewan, the Frobisher in particular, is the fabulous rock wall quality. It's really that conventional reservoir that we spoke about in the past on this chart, right? You can see Southeast Sask on the far right side of the permeability spectrum. And the reason I bring that up to answer your question is the Frobisher generally doesn't need fracks. So we're not in here even fracking. So the real change here versus 10, 20 years ago, where they were drilling single leg wells, is much like in other plays, we're drilling multi-leg wells, but here it's just 2 legs. So instead of drilling 1 mile, 1 leg, we're drilling 2 legs, half a mile. So you get twice as many wells on the same acreage and get effectively the same production. So you can really pack a lot of highly productive wells into a section and get great recovery factors from the bottom water drive, the active aquifer that exists here that pushes the oil into the wellbore. So you can get 20, 25, 30% recoveries on primary here. So, better mud systems allow us to drill a little faster, helping with the economics, but it's really been that move to the multi-legs here in the Southeast Sask that has really helped move it along even further.
So show one more slide. We're going to show you, look where this, here are the well results.
Yeah, that's what I was going to point out. They've been phenomenal. So,
Yeah,
and that's why I was wondering what you were doing a little bit different. Anyway, go on.
Well, I know exactly. That's exactly as Paul said. The proof's in the pudding. This is the top wells drilled in the entire province of Saskatchewan for the entirety of last year, all of 2022. We went and drilled our first 6 Frobisher wells down at our Steelman play, and you can see all 6 are sitting here as the top wells in the entire province of Saskatchewan for oil last year. So just fabulous public data reinforcement of the success we've been having in Frobisher in Southeast Saskatchewan.
So 2 years ago, less than 2 years, say 20 months ago, we had 0 production and 0 Frobisher locations in Saskatchewan. Now with 2 acquisitions, private co-acquisitions, plus our own guys, we have now, we're 8,000 barrels a day. We have 400 million barrels of oil in place, 275 lokes. 160 of those are Frobisher net, 160 over 200 gross Frobisher locations, 160 net in the company. And 2 or 3 other Frobisher bumps we have spotted on seismic and well control that we'll be pursuing in the second half of the year or next year. So this is such a lucrative play, and we're probably becoming fast one of the dominant players. We have a new study out of all the Frobisher wells drilled in Saskatchewan last 20 months, I think it is 18, 20 months. Surge's wells and our productivity are better than anyone's. We drilled 24 and are right at 200 barrels a day. IP, I think that's 60 or 90.
Yeah.
IP 90s. The payouts on these are 10, 12 weeks. Whitecap is a distant second to us. And then it goes down from there. But we're drilling the best, most productive wells on one of the top plays in North America. The key is we're drilling 25 of these a year, and we now have 160 in inventory and think we can add another 20, 30, maybe 40 more this year. So it's extremely exciting, light oil, high net back, and really gives a nice balance like in Q1 when the differentials were out on our Sparky, which is medium gravity crude. This thing, the diffs on light oil were about $2. And
so you can just drill more.
Yeah, so the cash flows, we could keep drilling this, but the cash flows of the company, it's one of the reasons why our cash flow is actually up, even though WTI dropped $18 US a barrel in the quarter over Q1 last year. So thrilled to be in here. I think we're one of the only bigger companies trying to grow in here. And Derek Christie, our VPX, has a good background in Saskatchewan. So we're thrilled with these kind of results.
Well, and I realized you did buy quite a bit of land at that land sale. in the last little while. But when you bought Astra and Fire Sky, I don't think you had any idea really that would you have 30 locations, I think, when
Yeah,
on
so we thought
Frobisher?
there might be about 20 to 25 Frobisher locations on the Astra deal. Then we drilled several of them. They were fantastic. Then that crown sale came up. We beat out Whitecap on the deal. So that vaulted us now. But we've also acquired other lands and then some more lands through Fire Sky. We're up to 160 net Frobisher lokes in Surge alone. 160. It's a stunner, and
It speaks to
have
your
more bumps. Yeah, more to do.
it speaks to your technical expertise in the area as well, that not everyone, it takes a, it's not an easy area to drill in either, right? So you need to know what you're doing.
Yeah.
So, okay, there's some questions. Your net reduction of net debt in the quarter, I think, was 22 million, was it not?
Yep, 22.
Yeah. Is there any plan to continue issuing shares and continue the dilution? No, I think you only issued shares to pay for the Enerplus deal, which was not dilutive. So I don't.
Going forward, we're always looking for accretion, particularly on free cash flow per share, so that existing shareholders have more free cash flow per share available for more dividends, more share buybacks, more special dividends.
And I bristle at the comment actually just because the Enerplus deal was massively accretive,
Yeah.
not dilutive. It's the opposite of what the question said. So the Enerplus deal was 15% accretive on the reserves that we bought. We then went out and owned it 9 weeks, and we paid 198 million cash to close. And 9 weeks later, the new sprawl came out, and our PDP reserves, PDP, were $287 million, and we paid 198. The P plus P booking half of the Cadogan lokes. We see 35 lokes booking half those. The P plus P sprawl report is $421 million for something we paid 198 million for. So to say dilutive, that is just completely not true. And I would love to buy the next Enerplus package if I could get something that good for shareholders. 15% accretive to our free cash flow per share. That's basically your earnings per share. Now that's on the old sprawl numbers. It's way more accretive if you
Accretive on the new ones. Yeah. So
yeah.
So I don't think there's any issue with, I mean, that was a perfect thing to issue stock for, to buy something like that.
Yeah.
So,
I looked to try to buy those assets for over 7 years. They're that good. They're beautiful, long life waterfloods.
So on that note, what are you seeing in the A&D market now with the volatility in price? It's usually, I mean, we've been saying this for months now. It's always hard to get deals done when there's volatility. Is there anything that you're looking at? Or, I mean, you have so much inventory, you don't really need to add, but if there's anything piquing your interest or anything you would want to dispose of, but that.
So we have 2 or 3 properties. The biggest being Shaunavon, 1,200 barrels a day. We've had huge interest in that over the last 6, 8, 10 months. With crude prices dropping, discs blowing out, now coming back in. It's just been a bit of a moving target. But our VP Land, Margaret, has always got data ready for non-core assets. We don't have many. We're going to exit this year with over 80% of our production coming out of 2 of the top 4 plays in North America, but we would always trim a non-core asset if we can get value for it. We don't see many acquisition packages that we like out there right now. So especially private cos that are up for sale, we have not seen very many. We've actually had several we crossed off our list that didn't meet our technical criteria. So we're kind of being pretty choosy, especially we're now trading just over our PDP NAV per share in the market. So it would have to be pretty attractive, high quality assets like Enerplus to get us even interested in buying something right now.
Yeah. No, I mean, you can buy back your own stock at a cheaper level than
PDP,
most.
exactly.
Yeah. Now, okay, any drilling completed in the Greater Son area? I don't think that's.
We were budgeting to drill 3 wells and have 4 injector conversions up there. But when crude crashed 2 times ago, it's just been very volatile. We adapted. Imagine cutting $15 million out of our Q1 program and still coming in above our exit rate for the year on average. But some of those casualties were the 3 Son wells and injector conversions. Love Son. We see over 100 really attractive drilling locations there, 600 million barrels of oil in place, a 6.8% recovery factor. The Waterfloods work. We have wells that have cummed over 600,000 barrels and are still flat at 50, 60 barrels a day. We love Son. So those, we don't even hardly talk about a play like that. That would make most companies would be thrilled with an asset like that. Because we have the Sparky and Southeast Sask, which are so low cost, we just focused on them when the price of oil is volatile or drops, because those places work, you know, as Jared showed you on that chart, when oil prices are really low.
No, it's okay. Yeah, it's like you say, the economics are good, but not as good as the Sparky or the Frobisher.
Yeah.
You're not doing any fishbone style.
No, we don't need to. So fishbone has become quite popular, particularly in the very heavy window, the goo, as Paul would say, of the Sparky up near Lloyd. That's where you have sand issues. You have unconsolidated rock and not good rock. We have great conventional consolidated rock. So we're really attacking the window between this dark bar and the light bar, what we call the heavier side of the light medium window, with multi-legs. Those are way more efficient capital wise. You don't have to be going in and out 41 times like you do in a fishbone. So those are really only done for sand issues, not applicable sorts of reservoirs that we have at Surge.
Yeah, you don't have any sanding issues, etc. So you don't need to. Hedging program, percentage hedge for the balance of the year, average price. You did mainly cost.
Yeah, so it's I don't have it on this deck, but it's available on our corporate presentation. You can see it at the back. We're 30% hedged for the balance of the year. We've purchased puts for nearly all of that, so we have nice $65 US WTI firm floors on our 30% of the production for the year. So that gives us protection for capital programs, dividends, etc.
Okay, and timing of divvy, if oil stays at 70.
Our dividend we're sustainable
increase.
Down to
Sorry. Timing of divvy increase. Yes.
Yeah. So the bottom line, we put out all our stuff at around 80 WTI. It's less than that. Our break even is just over 65 WTI, as Jared said. That's where we've got our hedges on. So we're in a mode right now of just watching crude. Crude's slightly up, I think today. It's kind of going to claw its way back, we think, but we're managing. And again, in breakup, we're not drilling wells or spending any money right now. So basically, we're looking to rationalize capital in the next 4 months, push it out, and continue to keep our debt coming down. Our debt should drop another it dropped 22 million in Q1, should drop another close to 20 million plus in Q2 here. So we're not planning to increase or decrease capital or dividend at this time at all.
Yeah.
Why is there bank debt still lingering? Being that oil has been above $80, but you had 50% of your production is heavier, and you did see diffs blow up quite a bit.
The question is, why is bank debt been lingering around?
Our bank debt has dropped from 451 million in the last 2 years to 55 million. Or what is the bank debt right now?
It's about we sat with the bank debt sitting at about $27 million.
So our bank debt has dropped from 451 million to $27 million. That is a massive, incredible drop. So the question seems to not really discuss reality.
Yes, I agree. And what's the number one priority for Surge?
Yeah, so currently, as Paul mentioned, in these volatile price environments, looking to continue to pay down that debt, get that bank debt to zero as quickly as we can, and continue to focus on reaching phase 2 of our return of capital framework, and then looking to do all the things I talked about earlier, dividend increases, buybacks, et cetera, once we reach that target. So in the near term, continued debt reduction, as we've said, and executing, of course.
I mean, I think it's like, obviously there's a lot of questions here on your liquidity. I mean, let's again focus on your, like, what is your stay flat capex? I think we need to reiterate that for some of these people in the audience, and then you're with the dividend, and then your free cash flow. I'm sure you've done sensitivity analysis. Let's say it's 65, 70, and 80. I mean, you were running your budget at 80 before. So, I mean, a lot of these questions, I don't think are really accurate given how much free cash flow you do have. And so,
yeah, we've talked about that. The amount of free cash, 160 million of free cash prior to the dividend at 80. Paul mentioned around 65. We've got a fully funded capital and dividend program. And so then you can sensitize in between there. Very torquey to oil here. So oil's up almost $1 last I checked here. So significant increases there, about $8 million of cash flow annualized for every $1 increase in WTI. So yeah, we're up $1 as we speak, so nearly back to 70. So it's we're in free cash flow mode here, and focus on paying down that further debt, as we said.
yeah, I mean, your stay flat's 125, and like you said, there's room for movement in that as well without having to take down your production numbers. So, yeah, I don't understand some of these questions, but anyway, let's move on. Okay. I look at your peers, and you're the best levered to oil, which is, I'm certainly not bullish on natural gas right at the moment. And I don't think we'll see a big, where, storage is nearing full AECO storage, and people are still, we're going to have, certainly, field receipts at record levels. Well, they're already at record levels. We've added 2.2 BCF into the basin in the past year. So, production is going to have to be shut in for a lot of gas producers. Prices are low, and they're not terrifically economic unless you're very liquids rich. And then it's just a byproduct. So you're the only company of your size that is 87% levered to oil. So that's, I think, a really big positive, but yet I don't think the market's giving you credit for that. You're trading at one of the lower EBITDA multiples compared to your peers. And then as well as, like you say, the 5.5% dividend yield. What do you think that investors need to see from you? Your debt reduction has been phenomenal. Your acquisitions have been phenomenal. You've been highly strategic with your acquisitions. And what do you think the market needs to see as we do have this dip here that provides a buying opportunity, to get you to the and plus the 1.4 billion in tax pools. So I mean, you're trading at a lower multiple than a lot of you guys that are taxable but don't have the inventory you have, and have paid a lot more for acquisitions than they really should have. So
yeah, I think we're the market is the market. It speaks. We're thrilled with the quarter. We were, I think, the second top performing public oil stock in Canada last year. The market wanted to see this quarter. I think just the overarching macro of these bank failures and OPEC's reaction. Just remember, nobody's even said this in all the research pieces I've seen in the last week, less than a week. With this latest drop in crude, OPEC stepped in and defended when crude hit 62, 63 on the Silicon Valley Bank going under. Already the Russian minister spoke out this morning and said, we're defending Brent. They were defending Brent at 90. Brent's just over 70. So I think there's an example of OPEC becoming hawkish again and defending the price. For short-term spikes down like this, I think people can overreact, but I think look for us to be kind of what we were last year, one of the top performers, TSR, total shareholder return in Canada, for all those reasons you said, Jess. We're 87% oil. We have one of the lowest declines, one of the highest netbacks, and two of the top 4 plays in North America is where we're putting our capital. that will win out. I think as Jared touched on, we just got to go execute, just like we did in Q1 here. That was a great quarter, a record quarter for us. Just keep putting out really good quarters, paying our dividend, high grading our capital, and the market's really smart. We keep doing that. Smart investors like that are on this call will see who the top companies are. And to your point, Jess, there's not many.
No, there aren't.
No, when I was running StarTech initially and even Crescent Point, there was 10, 12 top companies, Remington, Amber, Mike Rose's first company, Berkeley, StarTech. Yeah, there were all these top companies. There's not now. There's basically us, Cardinal, and Tamarack of the oily guys out there. I'm worried personally that Tamarack's debt is $1.4 billion is very high. Diffs were blown out in Q4. We don't need any failures, and they have a 40% decline. And now they're going to be a debt.
That's the other thing I was going to focus on is your 23% decline rates, which,
yeah, what wins out. That's exactly your point. So we don't have to put a lot of our cash flow back into the ground every quarter just to keep our production flat. That's what generates that free cash flow. So asset quality is super important in times like this. So I think to Jared's point, we just go execute, put out great quarters like we're gonna. The market's always smart, always responds if we keep delivering great quarters.
well, I think your guys are doing a great job. I'm a very happy shareholder, and using this opportunity to buy more because, like, I can get paid to wait as well as oil goes through this volatile times. So
You're only a few days away from your next dividend, Jess.
I know I can buy a new sweater or
There
two.
you go.
All right. Well, thanks, guys. And if anyone needs a one-on-one with the company or has any further questions, they can reach out to me at jessica@adcap.ca.
Thank you very much for having us.
Thanks,
Okay.
everybody. Take care.
Bye.